This is Aaron Merriman with Lujan Merriman Development Group. I want to thank everybody for joining us today. I'm looking forward to this discussion. I've been working with Bernard for a number of months now, and the Checkbook IRA is just an awesome option. Really, so for today, again, thanking everybody for attending. This is being recorded, and so it'll be available on our website after today. We'll get that posted, so if you have to drop out or you want to go back and reference anything, we'll certainly make that available. So really our goal for the next hour is I'll talk a little bit about Lujan Merriman Development Group, but I want the focus to really be about the Self-Directed IRA with Checkbook Control. In my opinion, the Self-Directed IRA and then with the checkbook is just such an awesome investment vehicle. About a third of our investors use a self-directed IRA to invest with us, and we'd like to make this interactive as well. So there's a chat window. If anybody has any questions, send those in. I've put together a number of questions just from talking with folks about this webinar in the last week or two, so we can kind of go through some of those things too. But we don't want it to be just about Bernard and I talking for the next hour. So certainly send the questions if you have them. Real quick, just a quick disclosure. Certainly this discussion is for educational purposes. If you have specific questions about our investment, or Lujan Merriman Development Group and our latest fund, we can certainly take those offline. And the same with Bernard. All right, so just a quick background on myself, Lujan Merriman Development Group, and then I'll turn it over to Bernard. Aaron Lujan and I have been working together for nearly 15 years doing value-add real estate investing. For about the last 5 of that, we have been focused on coastal property here in Southern California, where we're both based out of. But again, we are value-add investors, so we're looking to buy low, renovate, stabilize, and then sell. And I mentioned earlier about a third of our investors are currently investing with us using that self-directed vehicle because it is such a tremendous option, because you have the ability to invest in non-publicly traded entities or assets. And real quick, before I turn it over to Bernard, one of the things that I would like to say about him that is an advantage, in my opinion, because I do work with a lot of the different custodians and administrators and other companies that are out there in the space. The fact that Bernard is a CPA and a tax hawk really is really nice, because little things that you might have a question about here or there, he knows exactly what he's talking about, and you can be trusted that he has the training and experience. So with that, Bernard, I'll turn it over to you for a little background.
All right. Firstly, Aaron, thanks to yourself and LMVG for hosting this webinar, this presentation. And I welcome all the participants, and we hope to give you a very informative presentation covering self-directed IRAs in general and checkbook control in particular. All questions are welcome. Please use the chat feature to submit questions, and we'll try to address those. With regard to my background and the focus on self-directed IRAs and checkbook control, I'm a CPA with a background in financial due diligence and financial consulting to closely held businesses and their business owners. Within the closely held business space, the business finances and the personal finances of the business owners are closely intertwined. In that capacity, we dealt with all sorts of financial proposals that were brought to principals of large companies. And we began to realize a pattern in that space, and there are certain areas that were being neglected. And one of those is the alternative investment space. Whether we were dealing with a life insurance agent that had a life insurance structure to propose, or a stockbroker who had investments to propose, the alternative investment space, which should be an integral part of every investor's financial plan, was being neglected because of the lack of incentives. So everything's got its place, but we realized that there really is a void that has to be filled. And that has a very specific application within the IRA space. IRAs get formed generally through one of two ways. Oftentimes, a CPA or tax preparer will tell a client at year end, you can improve your tax return, you can get a tax deduction by contributing funds to an IRA, be it a SEP IRA, simple IRA, traditional, or Roth. But once the funds are in there and the tax return looks good because you got the tax deduction, those funds still have to be invested. And we find oftentimes that that's neglected. They were not invested, they just sit in cash, or they're invested suboptimally because people are not aware of the fact that they can take their IRAs and put them in the full array of investments that they choose. The other way IRAs get formed is because a financial advisor will induce somebody to form an IRA. The financial advisor will either get a commission on the sales of the liquid securities in the account, or they'll collect an asset under management fee for those funds that are sitting in the IRA. And again, the full array of investments and abilities that an IRA can engage in are not provided to the investor. So to fill that void, we developed this focus on self-directed IRAs with Checkbook Control. Aaron, back to you. Let's take a look.
Thanks, Bernard. All right, thanks, Bernard. So real quick, I wanted to just give a brief overview of LMDG and what we've been up to before turning it back over to Bernard. This slide is just a real high-level track record for myself and Aaron Lujan, going back to 2003, and I've kind of broken it out by year. But we're certainly proud of the returns. We've been extremely active over the last few years. There's tremendous opportunity right now in some of the things that we're doing. And I think one of the things that I'm most proud about is the fact that we have been able to sustain and make money in up markets, down markets, flat markets. So we have experience investing through different types of markets, and certainly distressed markets and the collapse that we saw from that 2008 to 2009 timeframe. Our latest offering is our second fund. It's a value fund that we launched about 60 days ago. And this is just, again, a quick overview on that. We're targeting $15 million. The fund has already purchased 2 properties. We have a third in escrow. We actually released our first unit to the new tenant yesterday on an 8-unit building that we're doing in Long Beach that we're very, very excited about and expect to actually have that property stabilized and sold by the end of the year. And so this is just a real high-level view of the fund. We pay out 100% of profits when they occur, so there is still a good opportunity for distributions with that. And then lastly, what I wanted to mention is we are doing, the fund is still open for new investors, but we're doing our first close for the fund effective at the end of this month. So if anybody is interested and wants to get in under that window, certainly reach out to me after this webinar, and I can send you some additional information on that. And again, this is just a high level of my background, Aaron Lujan's background, some of our big accomplishments, but we're doing deals right now in the $1.5 to $5 million range. We've done about $65 million plus in transactions. It's probably a little higher than that. We've done a few recently. So, we've been around and gone through some, distressed markets. All right, well, I'll turn it back over to you, Bernard.
Okay, let's get started. So the first slide, what is a self-directed IRA? Just want to provide a very high-level overview of what it is and what we're going to cover in today's webinar. A self-directed IRA is not a distinct IRA. It's not as if the tax code addresses regular IRAs, traditional IRAs, Roth IRAs, and self-directed IRAs. There's only one type of IRA that is created by the tax code. It's just that depending where you form your IRA, where that account is held, you'll have different abilities to direct your investments. If you form it with a large brokerage house, you'll be able to direct it to securities that are available on their platform. If you take it to a custodian that allows alternative investments, then you have the ability to direct it to assets that are off the platform, and that's the kind of IRA that has gotten to be known as a self-directed IRA. But it's not that it's different from the perspective of the tax code. It's governed by all the same rules that apply to the IRA that we're familiar with Schwab, Fidelity, Etrade, and all the others. With that, let's get to the next slide. So before we dive into IRAs, it's good to know the entire landscape of tax advantage accounts that can be self-directed. So while we're going to focus today on IRAs, and within the IRA category, there are traditional IRAs, Roth, SEP, and simple IRAs. There are also qualified plans, which are 401k plans that most of us are familiar with, as well as defined benefit plans, and Coverdell IRAs, also known as educational savings accounts and health savings accounts, which can all be self-directed. Very briefly, a health savings account is a tax advantage account that can be combined with a high deductible health plan. You can get tax deductions and tax savings by putting money, contributing to an HSA, and likewise those funds can be self-directed. A Coverdell IRA is a college savings account that is tax advantage. Funds can be put in there. They get tax advantage compounding, no taxes on the investment returns in the account, and those likewise can be directed to any investment. So it's good to know about these plans, and they may be available to you if you'd like to broaden your horizon. The most popular approach, though, is IRAs because they apply to everybody. Everybody is eligible to have an IRA. And the type of plans that fall under IRAs come in several flavors. Just to briefly describe the distinction between a traditional and a Roth before moving on. With a traditional IRA, you get a tax deduction for making that contribution. So that will enhance your current year tax return. If you make a contribution to that IRA, you'll get a tax deduction and lower your tax liability. Once the funds are in there, all earnings in that account are tax-free until they are withdrawn. At the point at which they are withdrawn, they are taxed. So the more accurate term that we use for these traditional IRAs is tax deferral. So you can get the benefit of many, many decades of tax-free compounding. The power of that cannot be overstated. It's really the compounding that drives your investment returns over time. The biggest drag on compounding is an annual tax bill, which depending on your tax bracket will be somewhere between 15 and 50% between combined federal and state. That is the biggest drag on the compounding of your returns. The power of the deferral can cause your account to be many times the size that it would be without the tax. You know, in the absence of that tax, your account can be many multiples of what it would be with the tax hit. That is contrasted with a Roth IRA. Roth IRA gives you no current tax deduction. However, once the funds are in that Roth IRA account, the earnings on those funds remain tax-free forever. There's never going to be taxation on any of the earnings within a Roth IRA. So once it's in there, that is tax-free forever. The question that we often encounter is, well, what should I choose, traditional or Roth? There are various factors to take into account. Just to touch on one, if you think your earnings are potentially going to be, well above and beyond what you would get traditionally, which would be looking at somewhere between 6 and 10%, if there's the possibility that you're going to have really astronomical returns, we encounter that most often, or most recently, those that are investing with their IRAs in Bitcoin, they're banking on it. The investment thesis is that cryptocurrencies, or one of those cryptocurrencies or a bundle of them, will have astronomical appreciation. Those folks tend to be inclined to use a Roth IRA because they're going to purchase a few $1,000s of crypto with the possibility, it is speculative, but that may be worth hundreds or thousands of times that amount sometime in the future. Okay, any questions about that? If anybody's got any questions about that before we move on, those questions are welcome. Aaron, I guess let's move on to the next slide. All right, in this IRA industry overview, we have a graphic depiction and just uncovering more layers of how the IRA industry is structured. At the top of that, we've got the Internal Revenue Code, sections 408 and 408A. Those govern traditional and Roth IRA accounts respectively. So it's a tax code that creates these tax advantage vehicles, and it's the IRS that implements and regulates and governs the tax code. The tax code, you can see here, it's that one tax code that leads us to the two options, the brokerage custodians on the left and the self-directed IRA custodians and administrators, or the SDIRA custodians that we've got on the right side of the slide. They both derive their tax advantages from the same section of the tax code. And it's important to note that the tax code requires that IRAs be custodied by a trust company or a bank, unlike qualified plans which do not require a custodian. IRAs must have a custodian. And in this illustration, we can see where the Checkbook IRA falls. The Checkbook IRA exists within the realm of the Self-Directed IRA Custodians. We'll get more into Checkbook IRA, its components, and how it works later on in the slides, but suffice it to say, with the Checkbook IRA, you're going to get your money in a bank account, keeping it within the rubric of an IRA. So you'll maintain the IRA tax advantage status of your account, although you'll be able to have the funds in a bank account. So it's going to be compliant with the IRS requirement that you have a custodian for your IRA, but nevertheless, the money can be yours to control and direct from a bank account. And let's take it to the next slide to get to a deeper layer.
And hey, Bernard, I've got a question for you that I've had from a number of existing investors that have they have LLCs set up with other things that they're doing. Are they able to use an existing LLC, or do they need to set up something new if it's just going to be for the self-directed IRA?
Okay, so that's an excellent question. It's getting a bit ahead of where we are on the slides. I would just say that's fine. But the short answer is that would not work. But I'd rather get to later in the slides where we see how the LLC fits into the IRA structure to give that question some context. But that's a question that's coming from somebody that's educated about the structure already. So in this slide, we're covering the IRA industry overview again, taking a deeper layer to understand what's driving the industry. So again, we've got the tax code, and then we've got the brokerage custodians, and then you've got the stocks, bonds, and mutual funds that they'll allow you to invest in. And it's important to understand what goes on in the traditional side of the industry to appreciate what goes on in the alternative side that we're going to be focusing on. And why is it that many people have not been exposed to their ability to use self-directed IRAs or to use checkbook control within a self-directed IRA? When you set up an IRA with a brokerage, you're accustomed to getting a free account. You can set up an IRA at any one of these platforms, Fidelity, Etrade, Vanguard, for free. And you will never get any type of invoice or any type of expense for having that account. But we do know that you don't get anything for free. And sometimes it's better the devil you know than the devil you don't. So it's important to be aware that where are the fees that you're getting on those accounts. And those fees are hidden either in your transactions, be they brokerage fees, or within the investments that you hold. So if you're holding an investment that's actually sponsored by the platform, today most of these brokerage platforms sponsor their own mutual funds, so then they're earning fees that are hidden within the fund. If it's a fund that's on their platform that they don't directly sponsor, then they're going to be getting some sort of kickback, some sort of marketing fees from the mutual fund on the back end. There's a link on this slide that you can access. It's from the SEC, and it has a good overview of some of the expenses that you get when trading on a brokerage platform. That's not to say that these are not great platforms. These are great platforms, but it's important to have the context, understand why things are the way they are. So these platforms are easy to transact on, but they're going to limit you to investing in the investments that they have available on their platform, because that's how they drive their revenue. They derive no revenue from actually giving you the account. Their revenue is from giving you those investments and from you buying and selling there. So they lock you in. They say, here's your free IRA, but you can only invest in what's in the platform. And as an alternative to this, the self-directed space opened up, and we'll get to that in the next slide. So as an alternative to the brokerage platforms, self-directed IRA custodians emerged. And that business model is fundamentally, it's kind of the diametric opposite to the business model of the brokerage custodians. As you can see as well, this is governed by the tax code, as we said. They are custodians that are approved by the IRS. But what they will allow you to do is to bring your own investments for them to invest your money in. You can invest in just about anything. The tax code does not places very, very few restrictions on what an IRA can be invested in. In fact, there is no list anywhere in the tax code of what you may invest in. The tax code simply specifies that IRAs cannot invest in collectibles. Collectibles would be some of the items that are enumerated there are alcoholic beverages, fine art, rugs, certain precious metals and coins, and life insurance. So the only two things that Section 408 proscribes for IRAs are those two categories, life insurance and collectibles. There's another section of the code dealing with S corporations that says that an S corporation cannot have an IRA as a shareholder. That's not an IRA regulation. It's part of the regulations governing S corporations, but those will generally be, depending on the section of the code that they come from, the three things that an IRA should not be invested in: life insurance, collectibles, and S corporations. Other than that, if you can imagine it, you can invest in it. Everything is theoretically accessible from the perspective of the tax code, which is very logical. The IRS, the Treasury Department, and Congress, they created these accounts to incentivize us to save and invest. But Congress had no intent of acting as an investment advisor. So they give us the vehicles governed by the tax code, but that just creates this shell, this vehicle that we can leverage, but we can choose the investments that we like. When investing with a self-directed IRA custodian, being that the accounts will not be free, being that they don't generate, they're not selling you investments, they don't generate any sales commissions from selling you an investment, and they're not generating fees from the investments themselves, your account with a self-directed IRA is not going to be free. You're going to have various types of fees. Those fees can be asset-based. Some custodians have asset-based fees, some do not, and you'll definitely have transactional fees. So you're going to have some sort of base fee that you're going to pay for having the account, or a base fee, and then the fees structure is very different. There are about 45 major players in the space, and they have different fee structures. So you can be paying a percentage of assets. You can be paying per asset fees. Each investment that you bring will have a per asset fee, and every transaction will have some fees associated with it. Because the way this works in the self-directed space without checkbook control, if you'd like to invest in real estate, well, you've got to get the deal, find the deal, put the deal together, but then take all the paperwork, submit it to the self-directed IRA custodian. The IRA custodian will review the paperwork, and ultimately they will process that paperwork and title the investment in the name of your IRA account. So the name title on the deed, or if it's a subscription agreement, is going to be XYZ custodian for benefit of John Doe IRA. So it's going to be titled directly in the name of the IRA account. And as you can see, with each investment, you'd have to go through that process. That can get to be cumbersome because it adds an additional layer of paperwork, additional time to get things processed. It's the paperwork may not be the investment sponsor who may be accustomed to working with individual investors and corporate investors now has to deal with unique paperwork to an IRA, which is distinct kind of paperwork. And the more investments you do, the more cumbersome it gets and the greater the fees that you can incur. But the benefit of these accounts are, for the most part, you get unrestricted investing. You bring the asset, they'll process it, and they'll get it done from you. So again, the pros for these are you can get to invest in almost any asset that you find, that you identify that you'd like to invest in. The downside is it gets to be very cumbersome, and it can get to be pricey if you're bringing more than one investment there or the value of your account is substantial. So to try to kind of give us the best of everything, the checkbook control structure can be implemented to give you the ability to invest in the assets that you choose without the cumbersome transacting that comes along with using a custodian. And let's get to that structure on the next slide. Okay, so this slide we see the structure of the checkbook IRA. And conceptually what this is, as we said, an IRA can be invested in any asset. Some of those that we saw listed on the prior slide were tax liens, private lending, real estate syndications, private equity, private companies. So being that you can invest, and that's very understandable, that you can take your IRA and invest it in a closely held company. Well, what we can do is we can create a private company that will be managed by the IRA owner. And that company will be invested in by the IRA custodian. The IRA custodian will transfer all your funds as an investment into this private company that's controlled by the IRA owner. And then once the funds are there, the IRA owner, as manager of that company, can direct the funds, can direct the company to invest in any asset that they identify as an appealing investment. And this is very similar to any kind of private equity investment that an IRA could make. You would invest the funds in a company, and the management of that company would run the business. Likewise, you can have your IRA make a private equity investment in a company that you control, and then once as manager of that company, you direct the operations of that company and direct it to invest in the various assets. The upside of all this is, from the perspective of the IRA custodian, all you have is a single investment. There's that one private placement, that one private company investment. All the other investments that you like to pursue are all pursued within that private company. Most often, we're going to use a limited liability company, a special purpose vehicle that's structured to be compliant with the IRS guidelines and custodian guidelines for investment by IRAs. So you're going to have control of that LLC, and all subsequent investments will be done in the name of the LLC. You've got a real estate investment, you just do the paperwork in the name of the LLC. Private lending investments, again, it's going to be in the name of the LLC. Cryptocurrency investment, you do it in the name of the LLC. And what happens here is you get complete flexibility. You can save substantially. You can have substantial savings, giving you more investable assets. You increase the ease of transaction. It's really business as usual. Everybody is accustomed to working with limited liability companies. You can increase your transaction speed. This is particularly important if you're looking to do sheriff sales, tax lien auctions, foreclosure auctions. You've got to have access to your funds instantaneously to make your down payment at the end of the auction to substantiate your bids. It enables you to get into investments that you otherwise could not get into. Bitcoin and cannabis are two examples that custodians have trouble with, and even if they do, when they do administer them, there are very, very substantial fees associated with that. So the checkbook control keeps everything within the rubric of the IRA, but gives you the flexibility and the freedom to transact quickly and keeps your fees down. And we got any questions here?
None so far. Keep
Okay.
going.
All right, so let's take it away. So to take a deeper dive into the structure of the Checkbook IRA, we've got a graphic outline in this image. So we've got the Self-Directed IRA Custodian at the center. We've got the IRA-LLC at the right. And in order to get these set up, there are multiple steps involved. The first step would be to set up an IRA account with a self-directed custodian. And we have custodians that we work with, partner custodians, that when implementing the checkbook control structure, they're ready to give very attractive pricing because they recognize that there's very little for them to do. They're not going to be doing much paperwork. They're not going to be doing anything on an ongoing basis more than just holding the private equity investment. So once you get up that self-directed account set up, it has to be funded. IRAs can be funded in three ways: with contributions, transfers, and rollovers. So at the top on the left, we've got IRA contributions. Contributions can come from earned income. That means if you want to put new money into an IRA that's not yet within an IRA or a 401k, you can make a contribution of $5,500 per year, $6,500 for those age 50 and above. In order to make a contribution in any particular year, you have to have earned income for that year, or your spouse would have to have earned income. That's known as a spousal IRA, and those are contributions, and those can be made directly to the self-directed IRA custodian. Another way to fund these are with IRA transfers. So if you've got an existing IRA, Roth IRA, Traditional IRA, SEP IRA at a brokerage custodian, you can transfer those funds. It's a non-taxable event, very straightforward. The funds go from one custodian to another. That's an IRA transfer, and these provide the opportunity to get substantial funds into a self-directed IRA. The other way to get funds into an IRA is a rollover. Rollover is very similar to a transfer. It's the terminology that's used when you're moving funds from a different type of retirement plan, a retirement plan other than an IRA. So if you're moving it from a qualified plan, such as an old 401k, it would be called an IRA rollover, rolling over funds. And again, these are some of the ways that very substantial funds get into self-directed IRAs. 401k plans provide an opportunity to accumulate funds at a much more rapid pace than IRAs. By rolling those funds into a self-directed IRA account, you can leverage those to get into alternative assets. Once the self-directed IRA account is funded, we would form the special purpose vehicle, the IRA-LLC, for investment by the IRA. As part of that formation, you have to determine which of the 51 domiciles. We've got 51 jurisdictions in which business entities can be formed. So we've got 50 states. We've got the District of Columbia. We've got to establish a bank account for the business entity, and you've got to figure out which banks can accommodate these and to streamline that process. Once the IRA-LLC is set up and the bank account is formed, we direct the custodian to make an investment, a private equity investment, into the IRA-LLC. Once those funds are in the bank account, you can go in there and you can process your investments on your own. The custodian is marginalized. No need to turn to the custodian at any point to process your real estate, your crypto, your gold, your private loans, whatever it is you'd like to invest in. You just write that check from the bank account. You can ACH. You can wire. Any investment returns, any investment profits and proceeds, they can just go right back to that bank account and immediately available to be redeployed in investments. So you can just keep rolling those over from investment to investment without having to consult the custodian. So you can move quickly and get into those assets. All right, let's get to the next slide, where we'll cover some of the rules, the key rules that you've got to be aware of when using self-directed IRAs in general and checkbook IRAs in particular. So anytime we set these up for people, we want to make sure they're aware of the prohibited transaction rules. The prohibited transaction rules are rules that apply to all IRAs. When you've got a brokerage IRA, it's just very difficult to run into them. You won't encounter them because you're restricted to investing in those mutual funds, publicly traded securities, so there's no opportunity to encounter the prohibited transactions. But prohibited transactions are rules that are there in the tax code because IRAs can be invested in any asset. And there's no reason from the perspective of the tax code to confine them to a particular investment platform. So conceptually, prohibited transactions are there to keep you from deriving any current benefit from your IRA. Congress created these vehicles to incentivize us to save and invest for the future. If Congress was concerned, if we can derive current benefit from these accounts, if there's a way to do that, perhaps there would be some abuse and we would not make sure that we maximize it for the future. So Congress instituted these rules to keep us from self-dealing with the funds and assets within an IRA. So in order to engage in a prohibited transaction, we have to have three components in place. You've got to have the IRA and a disqualified person and a transaction between the IRA and the disqualified person. And a transaction and disqualified person are terms that are defined in the code. And here we've got a fairly comprehensive list of who's disqualified. Disqualified persons are the IRA account owner, the spouse of the IRA owner, parents and grandparents of the IRA owner, children, grandchildren, as well as the spouses of those descendants, and any entity in which the combined ownership of any of the foregoing is 50% or more is a disqualified person to your IRA. Who's not, as you can see, not everybody that's related to you is a disqualified person. Siblings are not disqualified, in-laws are not disqualified, nephews, nieces, friends, aunts, and uncles. And of course, anybody that's not related is not a disqualified person. And what these rules say is they determine with whom your IRA can transact, not into what assets or the nature of the assets that you can buy, but with whom it can transact. And what this says is that in any IRA transaction, a disqualified person should not be a party to that transaction or a counterparty to the IRA. So if you own real estate and you're saying, hey, this real estate's providing me great returns, I'd like to shield it from taxation. Can I move that into my IRA and now protect it from taxation? You cannot do that. As a disqualified person, you cannot transact with your IRA. Your IRA can certainly buy real estate, but it cannot buy real estate from anybody that's considered a disqualified person. So you should not be in any way a party to a transaction. So although you can act on behalf of your IRA in any transaction in which you represent your IRA, you should not be a participant as an individual. You should never represent yourself as John Doe, the individual, in such a transaction. And this applies both to custodian controlled IRAs as well as to checkbook control IRAs. The opportunity to violate these rules and the required awareness applies regardless of the structure. And now that we've got an overview of the IRA industry, self-directed IRAs, and the checkbook control structure that can be implemented within self-directed IRAs, as well as the limitations, the prohibited transactions that we must be aware of, it will be good to address the pros and cons of checkbook control, which we'll get to on the next slide.
One question here, Bernard, that I think I know the answer to, but because with the checkbook IRA, you're setting up an LLC, do you have the opportunity to charge a management fee within the IRA?
Okay, yeah, that's a great question, and it's a great question because particularly the way we've presented it, it's a private equity investment, and you're going to be an officer or manager of that company. Well, whenever your IRA makes a private equity investment, the officers of that company are generally getting a salary. They're getting compensated. So it is logical to think that if you're managing your IRA, you can get compensated for doing so. Unfortunately, that's something that should definitely not be engaged in. That provides that will most likely be treated as a prohibited transaction. There was a case in the tax court in which that was treated as a prohibited transaction. So if you or some other disqualified person is the manager of the IRA-LLC, they should not take any compensation from the business entity for managing it. But that's an excellent question.
Thanks for the clarification. Let's see here.
All right, let's take it to the next slide. Okay, so considering all that we've clarified up to this point, we can see that the pros of a Checkbook Control IRA are the potential for substantial savings, ease of transacting, reduce the paperwork burden, and really the nuisance effect of having to have each asset, each investment processed by a custodian. If your I's aren't dotted and your T's aren't crossed, it can hold up your investment and can impact your ability to get into that asset if there's a deadline. Checkbook Control IRAs will provide asset protection. IRAs themselves are somewhat protected. It varies on state law from liability created by the IRA owner. But what happens if there's liability created within the IRA? Within the self-directed IRA space, you have the ability to buy real estate. Real estate can generate liability. If there's a liability generating event inside of a self-directed IRA, could they go after personal assets? Just like as if you had to own the real estate outright in your own name? And the answer to that is, it is very likely that they can. An IRA is a revocable trust, and if there is a real estate asset in there or any other asset that generates liability, there is the potential exposure on your personal side. Having it inside of a business entity, a limited liability company, gives it the same asset protection that you would have when you own any kind of business or asset inside of an LLC. You get the benefit of privacy. Privacy means different things to different people. Some people value it, place a very high premium on privacy. When you use Self-Directed IRA Custodian, most often any investment that you go into will be titled XYZ Custodian for benefit of John Doe IRA. Putting that name, putting the IRA account owner on title and in the public record. With using a limited liability company, in most instances, we're able to keep your name out of the public domain. You can participate in those auctions and sheriff sales, which you simply cannot do with the custodian involved, because at the close of any of these auctions, you're required to make a kind of a down payment to demonstrate that you're going to come up with the rest of the funds in your commitment. So you have to be able to write that check within a couple of hours. You can invest in assets that are unavailable to custodians. Cryptocurrency has been very popular. I must emphasize that cryptocurrency is definitely a speculative investment, but the premise of self-directed accounts are that you are free to choose. There's no reason why anybody should keep you from pursuing the potential upside that's associated with a speculative investment, and cryptocurrency definitely has that potential for astronomical return, but of course there is the associated risk. Custodians struggle to hold cryptocurrency directly. The few custodians they do are charging 10 to 20% of your assets just to get invested. They're limiting you can't get onto exchanges, you can't get into altcoins. So with the IRA-LLC structure, you can get into any coin, any token, any exchange. Cannabis has been presenting an issue for many custodians. Cannabis investments likewise seem to have tremendous upside, but being that we've got the disconnect between federal regulation of cannabis and marijuana investments and state regulation, custodians have trouble holding them. With the checkbook IRA structure, the custodian does not have to, because from the custodian's perspective, they're just holding a private equity investment. That private equity company, that company can invest in anything, including cannabis. So you get flexibility, ease of transacting, and savings. But there definitely are some potential cons to the checkbook structure. And what those are, the first one that will come to mind are the initial setup process and fees. In terms of the setup process, it's definitely easier just to set up a self-directed IRA account and stop at that. When using a checkbook IRA, the initial setup has many more components to it. You've got to figure out where should I put that, this LLC, where and how to open a bank account. And then there are going to be some additional fees, potentially. You may be offsetting those fees with substantial savings, but it's definitely something that has to be thought about. There's the fee to pay a professional to get the structure implemented. There are state filing fees associated with getting entities formed, and then there's the potential for ongoing fees, LLC maintenance fees. Now, these fees vary across the 51 jurisdictions, and they can be zero or they can be several $100s a year, and it's part of figuring out where should you put this, and then what would the costs be associated be. So there's that initial frictional cost that's associated with the checkbook structure. Beyond that, it's the prohibited transactions, which we've discussed. With a checkbook control structure, there definitely is an increased possibility for inadvertent prohibited transactions. Prohibited transactions can be engaged in regardless of whether you have checkbook control. However, when you've got the checkbook control and you have direct access to your funds, you can move quickly. But the downside is that you're not forced to spend 5 days thinking through the transaction. Anytime you want to do something, in the absence of checkbook control, if you've got to engage in an investment, you've got to fill out lots of paperwork, you've got to submit it to the custodian's got to process it. So you have 5 days for things to percolate and identify a potential prohibited transaction. And likewise, you want to make sure you've got that checking account not to use those for your personal expenses. You definitely do have the freedom to write a check to pay your personal utility or your personal rent bill. Nobody's going to stop you from doing that, but it would be a prohibited transaction. So with the checkbook control structure, there is definitely the possibility to more easily engage in a prohibited transaction. However, if you know the rules and you want to abide by them, they can be easily avoided. For those that want to violate prohibited transaction rules, you're able to violate those regardless of whether or not you've got the checkbook control. So as you can see, there are pros and there are potential cons. At ReSure Financial, we try to set things up so that you've got only the pros and none of the cons. We'll give you an overview of that in the next slide.
And Bernard, we do have a question in, and we are getting a little bit tight on time, so we'll try to get through these last few slides fairly quickly. But can you speak a little bit to, so we have a number of investors, obviously, that have worked with you that are in our fund, and they are setting up LLCs in other states, and just kind of a little bit about that, the fee structure and what they, because working with you is an extreme value in my opinion, not only from just a dollar standpoint, but obviously the service that you're providing, which to me is even more important. So can you touch on that just a little bit, and I think that'll help with this question that came in.
Yeah, good question. So the idea is, depending on the nature of the investment, sometimes the first thing to assess when determining which domicile was the nature of the investment. Because there are some investments that drive the determination of where an LLC should be domiciled. So if it's a real estate investment that somebody's holding a direct real estate, they're holding a direct investment in a real estate property, not going through a syndication or not going through a fund, then in general, you're going to want to have an LLC wherever the real estate is. But for other investments, and most other investments, we have more flexibility. So in the crypto space, we help people determine which state is best for a crypto investment. Some states are neutral, some states are friendly, some are anti. Now, when you domicile an LLC in any state other than your own, or in any, you're required to have a registered agent. So one thing that an LLC requires is to have an address within the state to which the Secretary of State can send any communication. So one component, whenever we set these up, if it's in your own state, you can actually be your own registered agent Some people prefer not to be because they want privacy, and using our services will give you that privacy, but you have that option. But if you go out of state, they're required to have that address. We provide that address for all the LLCs that we've got. Likewise, if you're in a jurisdiction that requires an annual filing, we can handle the annual filing and processing of the payments. The fees are, for us to handle that service, are very, very reasonable, and you're looking at something between $200 to $300 per year for us to manage the total compliance of the LLC.
Okay, great, thanks.
So as you can see, it kind of touches on what this slide really covers. So we can assist with every aspect. We help with the custodian selection. We work with many partner custodians. As CPAs, we have access to more custodians that are ready to partner with us, with the bank account, with custodian paperwork, with domicile selection. And a very, very important part of the service is educating about prohibited transactions and kind of addressing, there are some common pitfalls that we address as part of the setup to make sure nobody encounters those. And with regard to the cost, yes, as we can say, we try to keep these very fairly priced, and most of our clients are seeing immediate cost savings even though they're implementing the Checkbook IRA structure.
Okay, great.
All right, so here we've got, again, just a grid that outlines some of the providers in the space and the nature of their services, who's going to control your assets, what the custodian is going to be because it's going to be the custodian, facilitator, or ReSure Financial. You get to direct control of your assets. Who's going to help you select the custodian? Everybody's going to be happy to assist you with the custodian. And the custodians themselves, we say that tongue-in-cheek, they do very heavy marketing, but there really are meaningful distinctions within the custodian space, and it's important to be able to distinguish between the various custodians. With the implement checkbook control structure, the custodian will not implement it for you. Custodians, some are more or less receptive to the checkbook structure, but none of them will actually implement it for you, and very few will recommend it. If you ask for it, then they may have something to say about it. Assisting with ongoing compliance, the others will not. In terms of being able to advise on IRA compliance, nobody will do that for you. The custodian certainly will not. They aim to be passive. The majority of facilitators are not in a position to provide any form of tax advice or financial planning integration, something that we encounter often. Even at the get-go, from setting up IRA accounts and people's estate planning, they can make mistakes in how they title their IRA accounts and how they set things up, and we're able to address those and make sure they set them up optimally.
No, I think that's a great point, Bernard, and I'm sure you have many more horror stories than I do because it's a focal point of your business. But just as somebody that has an investment offering and works with investors who have self-directed IRAs set up at various companies, some of the administrators and custodians and different folks are, some are fine and some are extremely difficult to work at. So they're not all created equal, absolutely.
Okay. All right, this last slide moves away from the Checkbook IRA and Self-Directed IRA realm. It's just to briefly touch on Checkbook Control Solo 401ks, because everybody should be aware of these. These don't require a custodian or an LLC, so a lot of the downside dealing with the custodian or dealing with LLC maintenance does not exist when you use a solo 401k for investing. Solo 401k requires the presence of two factors to create. One is you've got to have some self-employment income. Self-employment income is any income that you're deriving from a trade or business. A trade or business does not have to be a company, a limited liability company, a corporation. Even if you're doing some consulting on the side and you're generating some form of ongoing income, that is self-employment income. That's a business. And the other factor is the absence of full-time W-2 employees. If you meet those two criteria, we can create a solo 401k with checkbook control that will give you direct control over your funds and allow you to invest in in all the investments that would be accessible within an IRA. The 401k structure has many other features that can make it very, very attractive. And for the purposes of this presentation, we just want people to know that it's an option. It's something to be aware of. I guess that concludes the slides for this presentation. If you've got any more questions, we've got just a handful, just a little bit of time. That we'll welcome.
Yeah, we just have a couple minutes left. I didn't see any more questions come in, but just a couple quick things just in my dealings with folks and getting ready and preparing for this that I thought were worth just getting your thoughts on. You know, is there any restriction about who can manage one of these checkbook IRAs? You know, husband, spouse, child. How does that work?
Okay, so good question. Let's address your question, and I can see that somebody here has got a question, and we're going to address that as well. So the first question you asked were, somebody's got an existing LLC, can they use that? And so the answer is, now that we know about the prohibited transaction rules and the contribution limits, any existing and the way this has to be structured definitely cannot be done. So although in all likelihood we use an LLC, within an existing LLC that you already own should not be transferred to the IRA. And in addition, almost all LLCs that are formed as part of your standard LLC formation process are not structured in a way that are compatible with self-directed IRAs. With regard to management of the LLC, interestingly enough, we get that question all the time. Can somebody else manage it? Can my spouse manage it? Can my child manage it? The answer is anybody can manage it. It's a private equity investment. There may be, if you like, there is perhaps even an enhancement to having somebody else manage it because, again, it keeps you further away from any of those prohibited transactions. You will not have signature authority potentially because somebody else will be managing the entity. And now a specific question that we encounter with LLCs, as we said, there's broad diversity between the jurisdictions. California is the chief offender. The Franchise Tax Board in California expects an annual fee of $800 from any business entity within California. So using the checkbook control structure within California, you definitely encounter that. And the Franchise Tax Board is not forgiving when it comes to their annual $800 fee. So as we said, the solo 401k does not encounter that. And the reason why solo 401k does not have that liability, that $800 fee, is being that it's a trust and not a state-formed business entity. Those fees do not apply. Therefore, yes, we can implement trust structures inside of IRAs. However, when we implement these, you know, it's a bit late in the presentation to address the nuance of it. We generally do not want the IRA owner being the trustee. So being that we don't want, in most cases, in the overwhelming majority of cases, the IRA owner wants to be the one that's going to have signature authority over the account, the LLC structure is more appealing. When we implement the trust structure within an IRA, we're looking for a non-disqualified person or somebody other than the IRA account owner to have the signature authority. It does work in some scenarios, but the overwhelming majority of people that we work with want to have direct signature authority.
So Bernard, so then the solo 401k falls under a trust terminology versus the LLC. Okay. We've got go ahead. I was just going to say we have another question that's just come in. Do you help calculate UBIT and or UDFI taxes for your customers?
Absolutely, for our customers and for those that are not our customers. So ironically, we have people coming to us that have their IRA accounts set up elsewhere or checkbook control set up through some other provider, but they're coming to us for their analysis of UBIT, UDFI, and filing of a 990T if applicable. So yes, we're definitely, as I said, it's all the one-stop shopping. We've got all the services under one roof. from implementation to ongoing compliance.
Okay. Okay, great. Well, awesome. Well, listen, we're out of time here. I appreciate the questions. Bernard, it's been great. It's always fun. Every time I talk to you, I get smarter on this stuff, and it's very exciting. So, again, you have our contact information, everyone. Thank you for attending. It will be live if anybody wants to follow up by the end of the week or early next week. It is Thursday. But again, thank you everybody for attending. Bernard, any final thoughts?
I think this has been a really, really great and comprehensive overview of the key things that everybody's got to be aware of when making a choice about using self-directed IRAs and implementing checkbook control. I welcome all questions from anybody. My direct email address is on this final slide. Thank everybody for listening, and I look forward to any questions that anybody's got. And Aaron, thanks for hosting.
All right. Have a great rest of the day, everybody. Bye.